Something extraordinary is happening in the vaults of central banks around the world. While politicians debate fiscal policy and economists argue about inflation, the world's most powerful financial institutions are quietly making a move that hasn't been seen since the collapse of the Bretton Woods system in the early 1970s. They are buying gold, not just buying it, but accumulating it at a pace that would make the treasure hunters of old weep with envy. Over 1,000 tons per year for 3 consecutive years running. That's not a trend. That's a revolution. The numbers are staggering. Central banks worldwide have purchased more gold in recent years than at any point since the abandonment of the gold standard half a century ago. We're talking about roughly 80 metric tons every single month, worth approximately $8.5 billion at current prices. This isn't pocket change for these institutions. This is a fundamental shift in how the world's monetary authorities view wealth, security, and the future of money itself. And here's the part that should wake you up. For 20 years, from 1989 to 2009, central banks were net sellers of gold. They treated it like an outdated relic, something their grandfathers might have cared about, but modern monetary policy had moved beyond. They sold it off, exchanged it for currencies and bonds, convinced that paper promises backed by governments were the future. But since 2010, that script has been flipped entirely. They've become aggressive net buyers, and after 2020, the pace has accelerated into something that looks less like portfolio adjustment and more like panic buying. What changed? Why are the same institutions that once dismissed gold as a barbarous relic now treating it like the most precious asset on earth? The answer lies in a combination of factors that should concern anyone who thinks the current monetary system is built on solid ground. Because when central banks start hoarding gold like this, they're not just diversifying their portfolios, they're preparing for something. The first and most obvious driver is the systematic erosion of confidence in traditional reserve assets, particularly those denominated in US dollars. The dollar's share of global reserves has plummeted from over 70% in 2000 to approximately 58% today. Meanwhile, gold's share has nearly doubled, climbing from around 8% to 15% during the same period. This isn't gradual drift. This is intentional rebalancing away from a system that central bankers increasingly view as unstable. The US dollar's 12% depreciation during 2025 alone has accelerated this trend dramatically. When the world's primary reserve currency loses value that quickly, every central bank holding dollars watches their reserves shrink in real terms. Gold, by contrast, has not only held its value, but has surged to unprecedented heights, breaking through $4,000 per ounce for the first time in history. That kind of performance gets attention in the halls of monetary power. But the dollar's weakness is just one piece of the puzzle. Geopolitical tensions have reached levels not seen in decades, and central banks are acutely aware that their reserves need to be positioned for a world where traditional alliances may not hold. Gold represents something unique in this environment. It's politically neutral. No government can print more of it. No sanctions can make it disappear. No policy decision in Washington or Brussels can devalue it overnight. When central banks look at their reserves and ask what will still have value if the current system fractures, gold provides the clearest answer. The acceleration gained particular momentum following April 2025, when sweeping reciprocal tariffs were implemented affecting major trading partners. These trade disputes triggered heightened concerns about fiscal sustainability and pushed diversification efforts into overdrive. Central banks that had been gradually increasing their gold holdings suddenly became urgent buyers, recognizing that the global economic order they had relied on for decades was shifting beneath their feet. China has emerged as the most significant force driving this transformation. The People's Bank of China has officially reported increasing its gold reserves for 18 consecutive months, adding over 300 tons during this period. But industry analysts believe the real numbers are substantially higher, as China has historically underreported its actual gold accumulation. The scale and consistency of Chinese buying represents more than portfolio management. It's a strategic initiative aligned with broader objectives to support the yuan's international role and reduce dependence on dollar-based transactions. The breadth of Chinese gold demand extends far beyond official central bank purchases. Gold withdrawals from the Shanghai Gold Exchange surged to 118 tons in September alone, up both month over month and year over year. Chinese gold ETFs are seeing massive net inflows, and futures trading volumes have spiked to levels that indicate institutional rather than retail activity. This comprehensive approach positions China as the dominant influence in global gold markets, with impacts that extend far beyond what any single central bank could achieve. But China is not acting alone. Russia has continued accumulating gold from domestic production, adding approximately 150 tons annually despite facing Western sanctions. For Russia, gold serves as a shield against currency volatility and international pressure, providing a reserve asset that cannot be frozen or confiscated by foreign governments. India has dramatically increased its gold reserves, adding over 200 tons since 2022 as part of a strategic diversification program that recognizes gold's cultural significance alongside its monetary value. Turkey has emerged as one of the most consistent buyers, increasing reserves by more than 250 tons since 2020, despite significant economic challenges. Poland made headlines with several large-scale purchases, including a single 100-ton acquisition in early 2025 that brought its total holdings to over 400 tons. Kazakhstan has been adding gold for 6 consecutive months, demonstrating that this trend spans diverse economies and political systems across multiple continents. The BRICS nations collectively represent perhaps the most powerful force in this transformation. These countries now hold approximately 20% of the world's official gold reserves, with Russia leading at around 2,335 metric tons and China following with 2,279 metric tons. Together, these two nations account for over 74% of BRICS reserves and roughly 15% of global reserves. The strategic implications extend beyond mere accumulation, as these nations are actively working to reduce dependence on the US dollar-dominated international monetary system. The expansion of BRICS membership amplifies this impact significantly. The group now includes not just the original 5 members, but also Egypt, Ethiopia, Iran, and the United Arab Emirates, accounting for 37% of global GDP and 44% of the world's population. When economies of this scale coordinate their reserve strategies around gold accumulation, the effects ripple through every corner of the global financial system. Historical data reveals the strategic nature of this shift. Since the global financial crisis, BRICS nations have shown an increased long-term preference for monetary gold as an alternative to currency reserves, with net purchases of 6.6 thousand tons between 2008 and 2021. This outperformed the global increase of 5.5 thousand tons, resulting in their share of global gold holdings increasing from 5% to 22% over the same period. The structural implications of this sustained central bank buying extend far beyond individual purchasing decisions. With annual gold mine production of approximately 3,644 tons, central bank purchases of 800 to 1,100 tons annually represent 25 to 35% of new supply. This creates significant pressure on available inventory and magnifies price impacts, as mining production cannot rapidly increase to satisfy surging demand. This supply constraint creates a feedback loop that central bankers understand perfectly. Every ton they purchase reduces the available supply for other buyers, pushing prices higher and validating their decision to accumulate while simultaneously making future purchases more expensive. It's a race against scarcity, and the smart money is moving first. The transformation in central bank behavior represents a complete philosophical reversal regarding gold's role in modern monetary policy. These are the same institutions that spent decades treating gold as an outdated relic, something primitive societies might have valued but sophisticated modern economies had evolved beyond. The World Gold Council's 2025 survey reveals the depth of this transformation. 95% of central bankers now forecast global gold reserves will grow this year, with 43% specifically planning to increase their own holdings. What changed their minds? Crisis after crisis has demonstrated that when systems break down, gold endures. During the 2008 financial collapse, while banks failed and currencies fluctuated wildly, gold held its value. When COVID struck and governments printed trillions to keep economies afloat, gold surged as investors fled depreciating paper assets. When geopolitical tensions flared and sanctions froze traditional reserves, gold remained immune to political manipulation. Central bankers have learned what empires throughout history discovered the hard way. Paper promises are only as good as the institutions that back them, and institutions can fail overnight. Gold doesn't require anyone's promise. It doesn't depend on political stability or economic growth. It simply exists, holding value through chaos and collapse because it cannot be printed, manipulated, or wished away. The speed of gold's recent price appreciation tells its own story. The metal accelerated from $3,500 to $4,000 in merely 36 days, demonstrating institutional demand velocity that cannot be attributed to retail speculation. This isn't day traders chasing momentum. This is sovereign wealth managers making strategic decisions about the future of money itself. Goldman Sachs has lifted their gold price forecast for December 2026 to $4,900 per ounce, citing continued institutional inflows and structural demand changes. But even these projections may prove conservative if central bank buying continues at current rates. The consistent sovereign purchasing provides crucial price support, creating a reliable demand floor that encourages additional institutional participation while discouraging speculative short selling. The psychological impact cannot be understated. When the world's most sophisticated financial institutions abandon traditional reserve assets in favor of an ancient store of value, it sends a signal that reverberates through every level of the financial system. If central banks don't trust their own currencies and bonds enough to hold them exclusively, why should anyone else? This dynamic becomes self-reinforcing as more institutions recognize the trend and position accordingly. Pension funds, insurance companies, and sovereign wealth funds are watching central bank behavior and drawing their own conclusions about portfolio allocation. The movement gains momentum as each participant validates the decisions of others, creating a cascade effect that could reshape global finance. But the implications extend beyond simple portfolio management. Central banks are essentially voting with their vaults, expressing a collective lack of confidence in the current monetary order. They're preparing for scenarios where traditional reserve assets lose credibility, where currency wars escalate, where the dollar's dominance finally cracks under the weight of unsustainable debt and political dysfunction. The timing is particularly significant. Central banks are accelerating their gold purchases precisely as global debt reaches unprecedented levels, as inflation pressures mount despite official reassurances, and as geopolitical fractures threaten the stability of international trade and finance. They're not buying gold because everything is fine. They're buying gold because they can see what's coming. Consider the mathematics. Global government debt has exploded to over $100 trillion, much of it denominated in currencies that can be printed at will. Interest payments alone consume growing portions of national budgets, forcing governments to choose between servicing debt and funding essential services. The temptation to inflate away obligations becomes irresistible when the alternative is explicit default. Central bankers understand this dynamic intimately because they're often the ones tasked with enabling it through monetary policy. They know that when governments face impossible fiscal arithmetic, they turn to their central banks for solutions. And those solutions typically involve creating money from nothing, debasing the currency to make debts more manageable, while destroying the savings of anyone foolish enough to hold cash. Gold offers an escape from this trap. Unlike currencies that can be debased or bonds that can default, gold maintains purchasing power across decades and centuries. Central banks holding gold reserves aren't just diversifying their portfolios, they're preserving their nation's wealth against the inevitable consequences of fiscal recklessness and monetary manipulation. The cultural and historical resonance adds another layer of significance. Throughout human civilization, gold has represented ultimate value, the asset kings and emperors hoarded when everything else proved temporary. Paper money is a relatively recent experiment, barely 3 centuries old and marked by repeated failures and reinventions. Gold is eternal, tested by millennia of economic turbulence and political upheaval. Central banks in emerging markets particularly appreciate this historical perspective. Many of these nations experienced currency collapses within living memory, watching their people's savings evaporate as governments printed money to fund spending or pay debts. For them, gold isn't just a portfolio diversification play, it's insurance against repeating the mistakes that destroyed their grandparents' wealth. The acceleration in central bank gold buying creates practical challenges for the physical market. Unlike financial assets that exist as digital entries, gold must be mined, refined, transported, and stored. The logistics of moving thousands of tons annually places strain on established networks and creates bottlenecks that can amplify price movements. Storage becomes increasingly complex as reserves grow. Central banks must balance security, accessibility, and political considerations when deciding where to hold their gold. Domestic storage provides control, but may lack capacity. Foreign vaults offer expertise, but create dependency. The decisions reveal strategic thinking about potential scenarios where access to reserves could become contested. The verification processes surrounding central bank gold purchases reveal another layer of complexity that most people never consider. When a central bank decides to acquire significant quantities of gold, they're not simply placing an order and waiting for delivery. These transactions require extensive authentication, chain of custody documentation, and physical assaying to ensure purity and weight specifications. The London Bullion Market Association sets the standards, but each central bank maintains its own verification protocols that can add weeks or months to major acquisitions. This verification bottleneck becomes more pronounced as demand surges. Refineries that once processed routine commercial orders now find themselves overwhelmed by institutional requests for specific bar sizes, purity levels, and documentation requirements. The delay between decision and delivery creates its own market dynamics, as central banks must commit to purchases based on current prices while taking physical possession weeks later at potentially different valuations. The insurance and transportation logistics paint an even more complex picture. Moving hundreds of tons of gold across international borders requires specialized security firms, diplomatic coordination, and insurance policies that can cost millions per shipment. These practical constraints mean that central bank gold buying cannot respond instantly to market conditions the way digital asset purchases can. The physical nature of gold imposes a deliberate pace that forces institutional buyers to think strategically rather than tactically. Regional patterns in central bank buying reveal distinct philosophical approaches to reserve management. European central banks tend to maintain stable gold positions, viewing their existing reserves as sufficient anchors against currency volatility. Their approach reflects decades of monetary integration within the Eurozone and confidence in established financial institutions. When they do adjust gold holdings, the changes are measured and well telegraphed to avoid market disruption. Asian central banks operate with different imperatives entirely. Many of these institutions serve economies that experienced rapid industrialization within the past 50 years, often accompanied by periods of currency instability and capital flight. Their gold accumulation strategies reflect hard-learned lessons about the importance of reserves that cannot be frozen by foreign governments or devalued by political decisions made in distant capitals. Latin American central banks present yet another pattern, with gold purchases often coinciding with domestic political transitions or economic reforms. Countries like Brazil and Mexico have increased their gold reserves during periods when domestic currencies faced pressure, using precious metals as a stabilizing influence on overall reserve portfolios. The timing of these purchases frequently aligns with electoral cycles, suggesting that gold serves both economic and political functions in these contexts. African central banks represent perhaps the most interesting dynamic in global gold accumulation. Many of these nations produce gold domestically, yet historically exported most of their output to finance imports and service foreign debt. The recent trend toward retaining more domestic production for central bank reserves represents a fundamental shift in resource management philosophy. Instead of immediately converting natural resources to foreign currency, these nations are building strategic reserves in the commodity they can produce most efficiently. The technological infrastructure supporting central bank gold operations has evolved dramatically to accommodate increased volumes. Sophisticated vault management systems now track individual bars through blockchain-based ledgers, providing immutable records of ownership and location. These systems integrate with international settlement networks to facilitate secure transfers between institutions without requiring physical movement of metal. Digital gold certificates have emerged as a compromise between physical ownership and operational flexibility. Central banks can hold legal title to specific gold bars stored in recognized vaults while maintaining the ability to trade those positions electronically. This innovation addresses some of the logistical challenges of physical gold ownership while preserving the essential characteristic that distinguishes gold from purely financial assets. The impact on commercial gold markets extends far beyond simple supply and demand dynamics. Jewelry manufacturers, industrial users, and retail investors now compete with central banks for available gold, fundamentally altering price discovery mechanisms. Traditional seasonal patterns in gold demand have been overwhelmed by consistent institutional buying that operates independent of consumer preferences or industrial cycles. Gold mining companies find themselves in an unprecedented position. Decades of underinvestment in new mine development, driven by relatively low gold prices and environmental concerns, now collides with explosive institutional demand. The long bring new mines online means that supply-led times required to constraints will persist, even if current high prices incentivize increased exploration and development. The environmental and social considerations surrounding gold mining have gained prominence as central banks increase their purchases. Institutions that once focused solely on financial returns now face pressure to ensure their gold acquisitions meet environmental and social governance standards. This creates additional complexity in sourcing decisions and may favor certain producers over others based on mining practices rather than purely economic factors. Secondary market dynamics reveal another fascinating aspect of central bank behavior. Unlike private investors who might sell gold during price spikes, central banks rarely liquidate their holdings for short-term profit. Their time horizons extend across decades, and their selling decisions typically reflect fundamental changes in reserve strategy rather than opportunistic profit-taking. This creates a one-way flow that continuously removes gold from available supply. The derivatives markets struggle to adapt to this new reality. Traditional gold futures contracts assumed a certain level of available supply for physical delivery. When central banks absorb significant portions of production and rarely return metal to the market, the relationship between paper gold trading and physical gold availability becomes increasingly strained. This disconnect periodically manifests in delivery squeezes that force settlement in cash rather than metal. Currency markets feel the secondary effects of massive gold accumulation through multiple channels. When central banks shift reserves from government bonds to gold, they effectively reduce demand for those bonds while increasing demand for the currency needed to purchase gold. These flows can influence exchange rates in ways that traditional monetary policy models struggle to predict or quantify. The psychological impact on financial markets extends beyond gold itself. Central bank gold buying serves as a visible indicator of institutional confidence in various asset classes. When monetary authorities consistently choose gold over government bonds, equity markets, or other traditional reserves, it sends signals that influence investor behavior across all asset categories. Market analysts now monitor central bank gold purchases as closely as they once watched currency interventions or interest rate changes. Monthly data releases from major central banks regarding their gold holdings have become market-moving events, capable of triggering rallies or corrections based on the pace and scale of institutional accumulation. The feedback loops between central bank buying and gold prices create increasingly complex dynamics. Higher gold prices make future purchases more expensive for central banks, potentially slowing acquisition rates. However, higher prices also validate the strategic wisdom of early buyers, encouraging continued accumulation by institutions that view current levels as justified by fundamental factors rather than speculative excess. Commercial themselves caught banks fin between competing pressures as central bank gold buying intensifies. Their traditional role as intermediaries in gold transactions becomes more complex when their own central banks are major buyers. Conflicts of interest emerge when commercial banks must balance profit opportunities against relationships with monetary authorities who regulate their operations. The global implications become clearer when viewed through the lens of monetary system evolution. Central banks are not simply adjusting their portfolios. They are collectively preparing for a world where the current arrangements may no longer function effectively. Their gold accumulation represents a hedge against scenarios that few are willing to discuss publicly, but many are quietly preparing for privately. The acceleration in central bank gold buying during 2025 has reached a pace that transforms gold from a portfolio component into a monetary phenomenon. When institutions controlling trillions in reserves consistently choose gold over alternatives, they create market conditions that validate their decision while making future purchases increasingly expensive. The self-reinforcing nature of this cycle suggests that current trends may continue regardless of short-term price fluctuations or policy changes. What emerges from this analysis is a picture of monetary authorities preparing for an uncertain future by returning to humanity's oldest store of value. Their actions speak louder than their words, revealing concerns about currency stability, political reliability, and systemic risk that official acknowledged communications rarely. The gold they are accumulating today may prove to be the foundation for whatever monetary system emerges from the challenges ahead. The race is accelerating and the stakes continue to rise. Central banks understand what history teaches and what current conditions suggest. When paper promises fail and systems collapse, gold endures. Their unprecedented accumulation in 2025 represents not just portfolio management but preparation for possibilities that prudent institutions cannot ignore. The ripple effects of this unprecedented central bank gold accumulation are becoming visible across sectors most people never connect to monetary policy. Insurance companies, traditionally conservative investors focused on matching long-term liabilities with stable assets, are quietly adjusting their strategies. They watch central banks abandon government bonds for gold and ask themselves hard questions about the wisdom of holding promises from the same governments whose monetary authorities are fleeing to precious metals. Pension funds face an even more complex calculus. These institutions must generate returns sufficient to meet obligations decades into the future, but they increasingly question whether traditional asset allocation models remain valid when central banks signal such profound skepticism about conventional reserves. The managers of these funds understand that their beneficiaries depend on purchasing power preservation, not nominal returns. When the institutions that create money lose faith in their own currencies, pension fund managers cannot ignore the implications. Sovereign wealth funds represent perhaps the most sophisticated observers of central bank behavior. These entities manage the accumulated savings of entire nations, often built from natural resource revenues or trade surpluses. They possess the analytical resources to understand exactly what central bank gold buying signals about systemic risks. Many have already begun their own accumulation programs, though they operate with less transparency than central banks, and their purchases often remain hidden until quarterly reporting requirements force disclosure. The technology sector finds itself in an unexpected position as digital payment systems and cryptocurrencies compete with gold for attention from institutions seeking alternatives to traditional money. Yet central banks consistently choose the ancient metal over modern digital alternatives. This preference reveals something profound about institutional psychology and risk assessment. Central banks trust systems that have survived millennia over innovations that have existed for barely a decade. Academic economists struggle to reconcile central bank gold buying with prevailing monetary theory. Modern economic models assume that sophisticated institutions will optimize returns through diversified portfolios of productive assets. Gold pays no dividend, generates no income, and contributes nothing to economic growth. Yet the world's most knowledgeable monetary professionals consistently choose it over alternatives that theory suggests should be superior. The disconnect between academic theory and institutional practice has created intellectual tension within economics departments and policy circles. Graduate students study models that assume rational actors pursuing yield optimization while observing real-world behavior that contradicts these assumptions. The explanation requires acknowledging possibilities that mainstream economic thought rarely considers, that the entire monetary system might be fundamentally unstable. The message from central banks couldn't be clearer. When the world's most sophisticated monetary institutions abandon paper promises for humanity's oldest store of value, they're not just adjusting portfolios. They're preparing for what comes next. History shows that when trust in money breaks down, gold survives. And if the institutions that create money don't trust their own system enough to hold it exclusively, perhaps it's time you asked yourself why you should. The race is on, and the smart money has already chosen sides.